Good evening. Ira Epstein of Linn Associates with your SPDR ETF wrap-up for this Thursday, and this is the 18th of June, 2020. Now, if you're looking for me this morning on my videos, I had a doctor's appointment, and you can't get into doctors. We're just getting back. I wasn't going to give it up, and it was a checkup, that's all, but it's what I've been looking on. You got to do these things when you can. I have a dentist finally tomorrow, thank God. Haven't seen him in a while. So let's talk about what we've got. Suddenly the markets have flattened out. The volatility, can't answer for you why, seems to have come out. Now that I've said it, it probably gets volatile again, but it seems to have come out. The disappointment today, of course, was the jobless claims that came out higher than the market was looking for. Market was looking for 1.3 million, it got 1.5 million. The other disappointment in the market is the rate of COVID new cases in California. I think there were 4,000 yesterday. Florida and Texas. Now, we know that President Trump's about to hold a rally in Tulsa, I think it is, and they're getting new amounts of cases. So is this just a flare-up? Is it not a flare-up and new testing that's getting it? I don't know. Don't claim to know, but I don't like that the numbers going up, and you put two and two together. Remember, in China, they've gone up again. They shut their schools down. 67% of the air flights out of Beijing have been canceled. Neighborhoods have been locked down. We'll find out what's going on. Anything else in the market? Not really. It's been pretty quiet. So we take a look at what's happened, and as I said yesterday, the old high that we made in XLK, and the two strongest parts of these different markets in the ETF, it's the QQQ, the strong one, and XLK is a spider. These are the powerhouses. These are the markets being part of tech that have been the strongest, and you can see you came up to that old high and you're just sort of sitting here. Now, for the first time in a while, we did get a pattern on the close of a lower high and a lower low, which in theory is a sell signal. Remember, you have to take a look at it and do two things. You got to look and see, number one, what knocks the sell signal out. That would be taking out 103.46 on the swing line. The second thing is you look to filter the swing line with where's the bias of the market. I define bias as the relationship right now of price to the 18-day average. When the price is over the red line, the 18-day moving average of closes, and this is a simple moving average, not weighted in any manner, I then define the bias as up. When I get a swing line down and the bias up, I have nothing. They counter each other. When I look at Bollinger Bands, you know what I look at them for. I consider the top part the resistance, the bottom part the support. The market will trade within them 95% of the time. 5% of the time, the market's going to exceed them. You want that to happen. You want the market to hit the band. Because if think like as I do, if I'm a pro trader, and I think I qualify as a pro, certainly. I don't know if I qualify for much of a trader, but you've got this part. You keep hitting it, you stop there. That's what the market's expecting. Do I think algorithms have built that strategy? And I do. Do I think pros that watch the markets build that in? I do. So I see a market that's got resistance at 104.60. It's gone into a pause because the swing line is turned down. The bias is up in momentum. Well, if you look at momentum, it's overbought. Any reading, I define any reading over 70 as being an overbought reading. There's an embedded reading. We'll talk about it if we see one. So you put that all together. This is all that I see in the market. Let's go to SMH. SMH has lower highs, lower lows, so it's replicating what the XLK is doing. It too is overbought. It too is over the 18-day average. The trend turns up in this if you get over 153, and back to the upside in the XLK if you get over 103.46. XLI stuck at the 18-day average, and that's often where a market goes and tries to fight a battle. I consider the 18-day average like the DMZ zone between North and South Korea. It's that safety zone. Markets like to go there to figure out, what do I do next? Do I stick my head to the upside, downside? And that's what this market's been doing, just hanging at this number. The trend is down, and for the first time in a while, the bias is down on the close. You closed under the 18-day average. So unless and until you take out 72.49, hitting 72.50, the next support is right here at 67.97. I do think the professionals are short this market right now, looking for that. What would turn the market bullish? Bullish would happen if you just got to 72.50. You'd have then higher low, a higher high, and the challenge of the 200-day average comes into play. XLE, no trend. You've got a pattern here of a lower low and a higher high. Now, can anything turn it bearish? No, not in this pattern. Can the market turn bullish? Yes. If you were to take out 41.90 and not take out 37.70 on the swing line, you could have higher lows, a higher high over that, see it? And that could set you up for a potential to the upper Bollinger Band. Doesn't mean you have to go there. You need momentum to turn with you, which it is not done yet. But momentum is oversold. It is not telling you to do anything. At least if you believe as I do that momentum leads price, it is telling you I'm oversold. It makes it hard to go short, and there's no sell signal. Flip that. QQQ is overbought. Any reading over 70 is overbought, and that's where you're at. So as much as this market's got the higher lows and higher highs, which I appreciate. It did, by the way, it created on the close today, and I said this wrong, it does not have a higher high. It's got the legacy of higher lows, but on the close, lower highs. Do you see that? So that's the first time you've gone into a pause. The uptrend resumes if you take out 245.50, the high of yesterday. However, you're still very overbought, and right in front of you is the upper Bollinger Band. Nothing is bearish to go short, but bulls can go again, but they'd be in overbought territory. In the emerging market ETF, no trend. You've got a lower low, higher high. Similar to the other pattern, I don't see any way to get bearish here. Bullishness could happen if you take out 62.02. It could potentially give you higher lows, then a higher high over that. Could lead to the first challenge again of the 200-day average of closes. Right now I see no man's land. GLD, the market is sort of stuck in the same way that I'm showing the others, sort of, but not completely. I could argue that I should take this and have it point down there. Any move over 162.69, that is the key to me, will turn the trend of this market up, unfortunately in an overbought territory. I think this market got married to that 18-day average, and for the time being, it just wants to sit there. I can see an easier play to the upside than the downside. In the gold miners, I see bearishness. I see lower highs. We've had the lower lows. We've had a rally back to the 18-day average that is failing. I would not be surprised to get to support at 31.77. Now, you should ask, what would turn the market bullish? Getting over 33.68 could create, assuming you don't get back under 31.32, higher lows, a higher high over that, over the 18-day average, obviously, could set up a challenge of the upper Bollinger Band. I think the pros will defend the short side of the market. TLT has no trend. The market got down to the 100-day average where I said some support might show, pop back over the 18. It's got lower high, lower low, bias up, and momentum overbought. In the euro, we were looking for a challenge where we were going to get down to that 18-day average. You missed it by 4 cents yesterday. And as I said then, and I don't change it, that's good enough. I think it made its run to it. Well, today it just wanted to prove I'm right. So losing the embedded reading, the theory is you go back to the closest moving average. It happened right here, and you can see it as crystal clear. Now, the market has also thrown out a sell signal. It's got a heck of a lot of risk, though, 130 points in this $1.30. And in the futures, you've had an extended one. I'm not saying don't take it. I'm saying it threw out a sell signal. So you put it together, you come up with game plans, and I have one for you. I've put together a package of my morning futures along with my afternoon Spider ETF video. These are subscriber videos. You don't see them on YouTube. You're not going to see them anywhere for free. And in order to get them, you have to sign up for them. Not expensive, my friends. $16. just under 17 for 30-day access, no contract. If you want to continue, it's $28 after that. And this is a bargain. If you bought each one separate, you would pay another 10% over that, closer to about $32. So maybe you want to consider that. I think it's an interesting way to see what I do and how I tie together the SPDR ETF moves right to the futures. That's why we made it a combo package. Simply go to our website under the word research. It's all there for you. You can also click here to get to it at any time. I'm Ira. You have a good day, and I'll see you all tomorrow.